Just a couple of admin points for all the attendees before I forget. We have a Q&A box. So if you have any questions, feel free to post them in our Q&A box, please. So welcome to our webinar for today. We will be talking about transfer pricing compliance in Malaysia. We are very excited to share some of our insights on this topic. But before we start and start discussing the detail, let us give us an overview of our firm. So I'm having a bit of a delay here. Essentially, our firm specializes in offering transfer pricing advisory services. We pride ourselves from being practical, proactive, and cost-effective. We love what we do, and we love to share everything that we know with all our audience today. And we also love helping multinational groups with solving complex transfer pricing problems. We have 3 offices. Essentially, our head office located in Australia. Our first expansion in Asia with our office located in Singapore, and also our office in Malaysia that caters to Malaysian taxpayers. We also are regular contributors of reputable journals, and we have won several awards in Australia and Asia, such as Best Transfer Pricing Team of the Year in Australia and Best Newcomer in Asia. We have also been categorized as tier 2 transfer pricing firm. And before we start with the topics for today, I would like to introduce our speakers. We first have Hon Chuan Tan, the Director of Transfer Pricing Solutions Malaysia, a brilliant mind with over 10 years of experience in advising multinational groups in transfer pricing. Prior to joining Transfer Pricing Solutions, he was a pioneer in setting up a transfer pricing practice for one of the leading accounting firms in Malaysia. We also have Kevin Tai, who is our senior manager with more than 9 years of experience in advising multinational groups with transfer pricing, and he's passionate about solving complex issues in transfer pricing. So if you have any questions, he and Hon Chuan Tan are definitely the people to go to. And I will be the moderator for today. I am the co-founder of Transfer Pricing Solutions Asia and Malaysia with over 15 years of experience advising multinational companies in the area of transfer pricing. Apart from advising multinational groups, I am also very passionate about teaching. And some of you, I see some familiar names here of people who have attended some of our workshops with the Institute of Singapore Chartered Accountancy and Singapore Accredited Tax Professionals. And with that, let's start with our agenda for today. So we will be talking about 3 key requirements in Malaysia for transfer pricing compliance. First, we will be talking about simplified versus full transfer pricing documentation. What are some of the differences and some of the misconceptions? 2, we will be talking about the related party form, which is quite an, I will say, underdog or forgotten form in the context of transfer pricing framework, and is basically the form that most taxpayers need to prepare to disclose their transfer pricing arrangements in Malaysia as part of the tax return. And last but not least, we will be talking about the country-by-country reporting requirements in Malaysia. So with that, I will pass the baton to Hon Chuan Tan to start talking about the difference between simplified and full TP documentation and sharing some of his experience on the common questions that we get asked from clients. So.
Right. Okay, thanks, Adriana. Hi guys, thanks for joining us. All right, transfer pricing in Malaysia. So the transfer pricing rules and regulations in Malaysia is pretty much in line with the OECD transfer pricing guidelines, even though they are not part of the OECD. The sole objective is to ensure that the transfer prices between controlled entities or related parties adhere to the arm's length principle, right? The principle itself. So the arm's length principle utilizes the circumstances of independent parties as a benchmark to determine your arm's length price for dealings between related party, right? So now in order to do that, taxpayers are required to prepare and maintain contemporaneous transfer pricing documentation, also in Malaysia. Next slide, we're going to talk about who it applies to.
2 seconds,
Right.
there is a bit of a delay.
Oh, let's
There
think
you
it's a
go.
delay too. Yeah,
Yeah,
cool.
go.
All right. Under the Malaysian transfer pricing rulings, taxpayers who enters into a controlled transaction will need to prepare a contemporaneous TP documentation. So here we're talking about the Malaysian rules that is actually being gazetted by law, right? However, under the Malaysian TP guidelines, there's an exception to this, to the domestic related party transactions between taxpayers that are both accessible and chargeable to tax in Malaysia, and any adjustment made will not alter the total tax payable. Now, for this statement, it's a bit tricky, right? First, you need to make sure that both entities are accessible and have the same tax rate, which means those with tax incentives or losses or labuan entities are most likely ruled out, right? Secondly, if you look at the second statement, you still need to ensure your transfer prices are accurate, because if the IRB were to come in and they were to make an adjustment, then there will be a change. When that change applies, then you most likely be an even worse position if you actually did not prepare that TP documentation. Right, that's very important. Next, I'll talk to you about the next slide will be about the contemporaneous, right? When it comes to TP documentation, you have heard a lot about the buzzword contemporaneous, right? But what does it actually mean in this context? Right, contemporaneous TP documentation basically means that the TP documentation is prepared during the development or implementation of the control transaction, or when there's a change in the business structure impacting the pricing. So this means that before a controlled transaction has occurred, taxpayers would have performed the necessary analysis resulting in an arm's length pricing, so that before the transaction has occurred, you will know that arm's length pricing already, and then apply that pricing accordingly. The TP documentation as well should at least be ready before the lodgement of your tax return. That's when you declare whether you have prepared a TP documentation or not in your real party form, which we'll go through later.
Yeah.
Right.
Do you mind explaining the fact that, or the importance on contemporaneous option number 1, which is why is it so important that we have contemporaneous documentation if in an ideal world when you are setting the price?
Yeah, I always tell my colleague that we always like TP planning engagement. That it's when client comes in, they tell us what the potential controlled transaction has been put in place. So for us, when we perform the analysis before it has occurred, and then when we apply the arm's length pricing onto that controlled transaction onto the relevant income years, right? You'll be confident and assured that throughout the income year, your pricing will be at arm's length, right? That's the main term of the contemporaneous, what it means. So you'll be confident that even if the IRB were to come in, if they look at the pricing, they'll know that you know that you have done your necessary analysis to make sure that it's arm's length, and that their generally will not, they'll significantly minimize your risks of an adjustment to your TP documentation going forward, and then it acts as a planning tool for you as well.
Hon, someone is asking if we could clarify what we mean by control transaction. And I guess
yes.
the misunderstanding is because in most of the TP guidance, you talk about related party transactions. So control transaction in this context for the person who asked equals related party transaction. It's just that we like to talk more about control transaction because that's the purpose of the transfer pricing rules, to make sure that they regulate pricing control transaction where the price can be influenced by the relationship.
Yeah. Hence the term controlled, right? You can control the pricing within that transaction. So which means it's called control transaction to be is equals to related party transaction. So throughout the slides, and also later Kevin will go through what it meant by related party and what it means to become a related party transaction in the Malaysian rules and regulation context.
Yeah.
Right.
So maybe do you want to share some of your views on or give us a brief overview on what is the difference between simplified TP documentation versus full TP documentation?
Yep. Now, Malaysia, a localized law, and then the Malaysian TP guidelines provided a leeway to ease compliance burden for smaller taxpayers, where taxpayers with less than Ringgit Malaysia 25 million in total revenue and Ringgit Malaysia 15 million in total related party transactions, or if there's a provision of financial assistance of less than RM 50 million for those non-financial institutions, then you can opt to prepare a more limited scope of the TP documentation, right? If you look at this, with this in mind, it shows that if you have cross-border or you have non-domestic related party transactions, you will have to prepare a TP documentation, be it a full or a simplified one, right? You can't run away from it, right? Once you have that. So bear that in mind. Next slide, I'll show you the differences between the two so that you know what we're talking about.
Yeah, go.
Cool. As you can see from the table, a fully fledged TP documentation requires a whole list of information, including company and group information, industry analysis, controlled transaction and its pricing policies, functional assets and risks analysis for the characterization of your entity, which will then lead to the selection and application of TP methods to test the arm's length nature of your controlled real party transactions, right? While for the simplified one, you're only required to document the company and group analysis, controlled transactions and its pricing policies, and then apply the most appropriate method to tests.
So next, Hong, can you share with us some of the common misconceptions? And I think one of the reasons why we want to share this point with all the audience is because it's a recollection of probably some of the most frequent asked questions that we receive in terms of requirements. So are you able to share with us what are some of the most frequent misconceptions that you find among taxpayers?
Yeah, there's a very common misconception of the simplified TP documentation itself, where people tend to read what's favorable to them in the guidelines, right? If you look at the new paragraph 1.3.2 of the Malaysian TP guidelines, it states that you only need to prepare subsection A, C, and D of the paragraph 11.2.4, which translates to the company information, control transaction, and the pricing policy, right? But then they stop reading from there, but there's more to it. But the paragraph later states that the taxpayer is allowed to apply any method other than the 5 methods described in the guidelines, provided it results in or best approximate arm's length outcome, right? What client generally do is, oh, I thought we're just gonna prepare A, C, and D, and that's about it. But then bear in mind that, as I mentioned earlier, it's all about the arm's length principle at the end of the day, right? Without doing any economic analysis, how do you know you're actually satisfied that arm's length principle if you only document down your company information, control transaction, and your pricing policy, right? And the simplified TP documentation is no exception, right? You're just not required to go through the selection of methods, but then, and you go straight to the application of the most appropriate TP method that you deem fit to test the arm's length nature of your control transaction. So at the end of the day, you still need to analyze and make sure that your controlled transactions are at arm's length.
Hong, so obviously a lot of the times when we're talking about transfer pricing documentation, seems a lot of the times as, okay, transfer pricing documentation equals compliance and that's it. But to put a bit of a bright silver lining here and a rainbow in the need of transfer pricing documentation, are you able to share with us some of the benefits of preparing transfer pricing documentation?
No problem. I guess the thing about clients, every time I come in, they'll be telling us, oh, it's just a compliance thing. We don't have a budget for it. But you need to look more on top of the compliance requirement, right? First thing that comes to mind is, of course, it acts as a penalty protection at all fronts when prepared properly, right? Make sure it's prepared properly and not just a group of information gathering sheet and then you treat it as though it's a TP documentation, right? It is a defense mechanism for your transfer pricing position in the event of an audit, right? And the effort to actually maintain a contemporaneous TP documentation is recognized as a good practice by the tax authority, right? We like to anticipate that all the questions that IRB will ask will be in your report, in the TP report, to show the IRB that we have covered all the grounds and we know what you're going to ask and we have all the answers in that TP report, so that that is to first minimize any questions asked, then give a definitive answer to IRB that you know what you're doing and you know that you're doing the right thing and that you're pricing out at arm's length, right? That's the main goal, right? But a major benefit for preparing a TP documentation is not just to treat as though it's a compliance requirement, but you need to treat it as though it's a planning tool, right? For your company to further understand your business operations and not just the pricing alone, but also the effectiveness of the supply chain of your business. So an interesting fact that when we prepare TP documentation, you'll be amazed from the queries that we raised. We may have identified any weaknesses within the businesses that the management would or may not have realized. And at the end of the project, it generated ideas for the client to relook at their business structure and then possibly restructure the supply chain for it to be efficient and effective. So if you look at it this way, it's not just about TP anymore. It's about looking at your overall supply chain, be it with related party or third party, right? You can use that as a planning tool to value add, right? That's where the value add comes in. So always make good use of the TP documentation, not just for compliance purposes, but as a planning tool.
Excellent. So would you able to just explain what are some of the non-compliance penalties, especially in light of the new legislation?
Yeah, unfortunately, post-COVID, it's there. Just to refresh that the penalties are actually pretty hefty, with the first failure to furnish within 14 days, costing upwards from 20,000 to 100,000 and up to 6 months of imprisonment for the directors out there. On top of that, if the arm's length principle is not adhered to, adjustment will be made with penalties ranging from 20 to 50% on the additional tax payable, coupled with a surcharge of 5%, up to 5%, regardless of the taxable position, right? There are also other reduced penalties if you voluntarily disclose your position to the IRB, right? So bear these penalties in mind.
Before we move into the second segment, I'm just going to read out a couple of questions that have been raised because they are mainly related to TP documentation. So one question is, how do you, let me just put it live so you can all see it. How do you maintain contemporaneous pricing on all transactions within a group if business is always evolving, particularly during this pandemic situation, and we are trying to evolve to stay afloat?
Yeah, unfortunately, with the COVID situation coming in, the compliance burden on taxpayers has increased, right? When a business is evolving, when the business has to take further initiative to gain sales, to reduce expenses, any measures performed by the group of or the entity that potentially changes the business structure, then this has to be closely monitored. And then when we say about maintaining contemporaneous, let's look at within that income year, what impact would that make to your particular transaction? So we are looking at your control transaction, right? What impact has that made? For example, you have received a government grant. What are you going to do with that government grant, right? There are certain jurisdictions that will inform you that if you have government grants, right, what you do to that government grant will impact your pricing. And generally speaking, you shouldn't be using that government grant to change your pricing per se, right? It's for the government to help your entity in your jurisdiction to make sure that you stay afloat and not go bankrupt, not to change your pricing with your related party or reduce it because you have the government grant, right? So basically, at the end of the day, you still need to monitor your business operations. Then if there are any significant changes, then you really need to change that in your TP documentation.
And I will add to this that the way to look at it is essentially on annual basis, which is why the TP documentation ends up being so important in the context of supporting your tax position year by year. So the whole principle behind it is that if there is, as you said earlier, if there is a change during the year that impacts the price, then you cover it in the transfer pricing documentation update for that particular year. And that's the way in which you can ensure that you can maintain it. There is another question, which is where can I find the exemption rules for TPD in Malaysia? Is there a guidance that I can refer to?
Yep. So basically, you can go through the Lembaga LHDN website, or if you Google LHDN Malaysian TP guidelines, then you're able to find the link to the latest Malaysian TP guidelines 2012. But bear in mind that there are a lot of changes that has happened, so you can't just refer to the actual PDF because that's the older version. They actually have a newer version or updated version in the website itself. So make sure you refer to the latest one on the exception rules.
Yep. And there is one last question before we move on, and then we will answer the latest question at the end of the segment, which is, and it's an interesting one. Is there any purpose of putting in the organization structure in the TP documentation, which we usually see? So I guess this person is asking, what is the purpose of putting the organization structure in the TP documentation?
Yeah, I can take this one. So when you look at organizational structure, oops, there's another question, sorry. I was looking at a question, it just jumped up. Okay, so when you look at organizational structure, what is the purpose of that in transfer pricing documentation, right? It links to our a particular analysis we do in the transfer pricing documentation, which is what we call a functional analysis. This structure basically helps to map out what type of activities, functions that you play in the company. For example, do you have a HR department? Do you have a financing department? Do you have a sales department? What differentiates you from, let's say, a distributor versus a service provider? And this organizational chart gives sort of like a map for us to go through, to analyze what is your role in the supply chain of the company and what are you doing in Malaysia. And that then leads to deciding how we are going to test you in terms of result from a transfer pricing perspective. How can we show that your result is consistent with the market rate or the arm's length rate?
Correct. So I think that's the main reason why in most transfer pricing guidelines in the region, but let's talk about Malaysia, there is a specific requirement that that organizational structure needs to go together with the employees' headcounts. And that's probably why tax authorities would like to see that. My experience in audits is that if you don't have it in the documentation, the tax authority will ask for it. So that's something to keep in mind. Then with that, Kevin, now I will love you to share some insights on the related party forms in Malaysia and why are they important to keep in mind as part of the transfer pricing compliance.
Sure, thanks, Adriana. Look, the RPT form, I'm sure most of you are familiar with, but for those that are not familiar with, just to give you a bit of background of what this form is, it's basically a disclosure that you make, which gives the IRB a snapshot of your company's transfer pricing arrangements. This is part of your Form C that you lodge with the IRB as part of your tax return. Okay. Now, this is, well, you can say that this information is actually the primary or the first source of information the IRB gets in relation to your related party dealings. They use this information to do their risk assessment, basically to identify who are the high risk entities in Malaysia, and then they can work out their priority risks when they are doing their tax review. So because of the tax assessment mechanics in place, it is very important to get the disclosure right in this form to avoid any unnecessary, administration tasks. To give you an example, your transfer pricing may be right, maybe consistent with the arm's length principle, but because you have made a wrong disclosure, that may have raised some red flags with the IRB, and they have picked you up for an audit or a review, then it just gives you a lot of administration tasks and use a lot of your resources to just go back and forth with the IRB to clarify all this up, which can all be avoided if the form is done right. Okay.
Can you then share which taxpayers have to complete their related party form?
Yeah, so it's really quite straightforward. This one is just one general rule. If you have related party transactions, doesn't matter whether or not it is a domestic transactions or it's a cross-border international transactions, you will need to fill in this form. Now, one interesting part is a couple of years back, they added in one question that asks you whether or not you have prepared transfer pricing documentation. Now, we all know one of the benefit of having transfer pricing documentation is the penalty protection it gives you, at least if you have a contemporaneous one. Yeah. If you connect the dots of why this question is in there, you are indirectly telling the IRB whether or not you have a penalty protection in place for the year.
Yeah.
Yep. So it's very important when you review, when you go through your tax lodgement process, when you review your approach on your transfer pricing arrangements or transfer pricing compliance engagement, you have a think about that, whether or not this is something that you need to pay more attention to. Yeah. Okay, I think here we have provided a snapshot of the RPT form for those that may not be familiar with this form. This is how it looks like. We are not going to go through in details on how you can fill in this form. We are just going to show you what sort of information that you are expected to be disclosing in the form. So if you look at the form, you have two parts to it. So part A is more like your company information. This is where you disclose your qualitative information. This is where you talk about what is your business activities, what industry you are in, who is your ultimate holding company for the group. If your holding is different from the ultimate, who is the immediate holding company for your company? And obviously, number 5, you have your whether or not you have prepared a transfer pricing documentation. Then you move into part B, the next one.
2 seconds, because there is a delay with this
one.
No. There you go.
There you go. So then you have your part B. Now, this is the juicy part. It's split into two sections. I would say you have a domestic disclosure, the domestic transactions, which is the in Malaysia column. It is disclosed according to revenue versus expenses or asset versus liability, depending on the item. And then the other side, you have outside of Malaysia, meaning your international cross-border dealings. Okay, and this generally captures all of your related party dealings for the year. Okay.
There is a bit of delay. Give me 2 seconds.
It's all right.
Hopefully, I don't know if the images here were a bit heavy, and that's why. There you go. Now you can continue.
Okay, so why now? Some people ask, why did the IRB develop the form, right? If you go through, now we have gone through, the form, and we know the details of information that you are providing to the IRB, you can sort of gauge why they come up with this form. First thing is just transparency. They want to know in more detail of your related party dealings. Now, bear in mind, before this form, where will they get this information from? I mean, I'm talking about before they actually comes to you and ask you a bunch of questions or request for a bunch of documents. They get all this information from the financial statement. Financial statement, you may have to disclose related party dealings in the notes to financial, but it's not as comprehensive as what the RPT form is. You may not need to disclose or separate between domestic and international in your financial statement, but here you have that information. Okay. With this information, they can go back and do their risk assessment more efficiently and focus, and then they can allocate their resources focusing on the high value or priority targets. Now, this also allows them to, enforce the type transfer pricing rules and compliance to the arm's length principle more efficiently. Okay, so what does the IRB do with this information? Again, if you think about it, it's always about risk assessment. This is their first phase. Take it as their first phase, their primary source of information. They will take this information and they will group you up in categories. If you have a high value transactions, they will put you in certain categories. If you have certain high risk transaction, they will put you in another category, and then they would look at whether or not your financial performance is stable and is consistent with the market rate. Because if you are not, or if you are earning lower than the market rate, and at the same time you have all this red flag, like you have high volume of transactions, you have high risk related party transactions going on, then it sort of tells them, hey, we need to have a look at this company.
Kevin, would you
Yes.
be able to share some of your insight or some insight on what is the typical risk factors that may give rise to IRB scrutiny?
Oh, yes. Yeah, there are a few. So you have, well, always the first one, the volume. Obviously, the higher volume of transactions you have, generally the higher risk you will have. But on top of value, they also look at who you are transacting with, in particular, which country. If you are transacting a lot with countries with lower tax rate or zero tax rate, there are a clear incentive for the group to shift profit there. It doesn't mean that you have done it, but it's perceived that you have the incentive to do it. So there's a risk factor. Obviously, then, as I mentioned, they always compare your overall profitability to the industry. Now, this information is not in RPT form, but it's part of your tax return. They have all this information already. They will look at whether or not you are in consistent losses. You are making losses every year. Do you have a wide swing of profit and loss across a period that is not consistent with the industry, or are you just earning below than average? Combine this with the two factors that I've mentioned earlier, you have an idea of how risky you are. And then the last two here is more related to IP, transaction related to IP or development of IP. Now, IP has always been a controversial topic in transfer pricing, for a clear reason why, because they are often unique and very hard to price properly. And also in the past, historically, IP has been used by multinational to shift profit to tax havens. And this has been caught, many of them has been caught in the past, and it raises a lot of awareness in TP from then on. It sort of, it's indirectly pushed the OECD to go into the BEPS initiative. So when you have a large volume of IP or development IP activities in your RPT form, it sort of raises skepticism of the tax office. It's just like a red flag. It's a remnant from the past.
And last,
Yeah.
before we move on into country by country reporting, I think some people are asking questions on
Sure.
the related party definition. So hopefully we can answer some of those questions
Yeah.
here.
Now, I think what we mentioned just now pretty much summarized the RPT section. Now, this is not directly related to RPT form, but it can impact the disclosure that you've made in the form. Some of you may be aware, or some of you they are not. Effective January 2019, there has been an update to the definition of related party. In the past, related party have to have 50% of more shareholding control. Moving forward from January 19, the shareholding criteria needs to be only like 20% and above. And then obviously the other applies, which is, operation of dependent on the rights, means you have control of the operation of the company. And then you have one or more directors in the board of directors of the company to consider a related party. Now, how this may impact you is, in the past, before the update of this definition, you may have transactions with certain related party, but because of the 50% shareholding criteria, you did not treat them as a related party and not disclose any dealings with them. Now you might need to go back and revisit your previous assessment and see whether or not you need to include that into your disclosure moving forward.
Thanks, Kevin. So with that, I'm going to open some of the questions that are related to this topic before we move on to our last topic of country by country reporting. So there is quite a few interesting questions here. One of them, which I'm gonna put live, are in law within the definition of relatives for purpose of section 140, which is this one, as the section 148 did not include in-laws within the meaning of relatives.
Yeah, I'll take that then.
Okay.
That's a bit of a funny one, right? So basically, section 148 5B, right? In that definition, it says that the meaning will be similar to section 148 and 140 subsection 8. Right. If you look at section 140 subsection 8, the relative definition includes parent, child, brothers, sisters, auntie, aunts, cousins, ancestors, or descendant. But then they didn't really go through the detail of the spouse side, right? So if I'm just looking at the law itself, based on section 140 subsection 8, then I would deem that as in-laws does not apply in this section. But again, I've also seen laws that includes the definition of relatives as well, that includes the spouse side, right? But for section 140A subsection 8, based on the definition, it doesn't include in-laws, right? That's the tricky part.
Can I chip in a little bit? Just in relation to this, the section 148 5A or 5B, I think what we are trying to achieve here is to determine whether in-law can be considered a related party. Is that what this question is about? If that's the case, it is generally then follows the definition of related party. It doesn't have to be in-law or a separate party. It can be in-law or an independent party. As long as it meets the criteria of a related party, I believe it should be included as part of the should be considered a related party for these purposes.
I also have a view on this.
Yeah, because
similar
as long as
to
they meet
Kevin.
the shareholding criteria, they have control of the management decision. You have someone, or you have one or more directors, or you are the directors of that, then it's likely that you will fall within the related party definition.
I actually feel that maybe under that section that Hong cited, which is section 148, may not be included, but it happens to be a shareholder, it might come under this section, right? Number 3, which is if that person is a shareholder and has the ability, I think the question here, influence. So if they can influence the price by being common shareholder and common director, or putting the shareholder here, the in-laws, but at the end of the day, who is making all the decisions is one person. I think the substance has to be looked into. If you're going to say, but you can argue it both ways, right? Because you could say, well, I don't even get along with my in-laws.
Yeah.
I have no option to influence. So, or they have no option to influence what I do. So I think the word influence and the possibility of control is the determining factor to say one way or the other. Now, I think that in a court case scenario, you have some level of certainty due to the definition in section 148.
Subsection 8, yep.
Yeah, but it will be in the hands of the tax authority to actually be able to prove that even though that in-law is not within the definition, had the power to influence. And if they do prove that, then maybe it is a related party. So I think the point here is control or influence.
Yep.
There is another question which is related to, let me just answer a few, and then maybe we continue and then we answer more at the end. A couple of more and then we finish at the end. Do you need to complete this form in respect of all related party transactions, irrespective of the amount, meaning if it's only 1 million ringgit?
1,000.
Sorry, 1,000. Is there?
Yeah, I think that I don't think there's a threshold to a minimum amount that you need to disclose, as long as you have as long as you have a transaction that is deemed to be with a related party, then you disclose in the RPT form.
Yeah. Last question, and then we will continue with the other ones. So will it trigger IRB if we answer in question 5, no to not having transfer pricing documentation?
It doesn't necessarily trigger IRB. I mean, if you're talking about a review and audit, it's almost like a whole package, right? If you look at risk assessment, it's not only whether or not you have documentation, it's whether the transactions that you enter into is really a risk to the to the tax base of Malaysia. Are you deemed to be as a high risk taxpayer that may have the incentive to shift profit out of Malaysia? Now, this can be many things. If you have certain high value of transactions, like I mentioned, then yes, and then also they will also look at your financial performance of the company. If you're very profitable for the past many years, it's not likely that you are underpaying tax in Malaysia. Therefore, your risk may not be as high as opposed to those that may be in losses. So definitely transfer pricing documentation, if you have, it's good. But if you don't have it, when you discuss you don't have it, doesn't necessarily trigger a review on you. It depends on many other factors.
Okay, thanks, Kevin. So
or maybe actually I want to add on to that. where I would imagine that there's two parts to it, right? What you have to look at what IRB has access to. First, the SSM, which is the audited accounts. Secondly, the income tax return, right? So when they have that two in place, of course, I'm not sure how good the IRB systems is. You know, if you look at the off-COVID system, something has gone wrong there. But if you look at the IRB tax system, if it's better than our current COVID system, then they might be able to catch these so-called low-hanging fruits, right? I'm talking about those entities that have related party disclosures in your audit accounts. And then when you tick no, basically you're telling the IRB that, yeah, I don't care about my real party transactions. You can come and I'll give the bullet and shoot me back, right? So basically, it won't necessarily trigger, but I'll imagine IRB would have that risk engine where if they have a list of entities with related party transaction and a list that tick no on the TP documentation, then you would have raised like a red flag, or you'd be one of those low-hanging fruits entities that IRB may target you, especially when the new development of the failure to furnish TP documentation, right? The whole point is to see whether you have TP documentation in place. If you have tick no and you have related party transaction, then straight away come in, then impose you that 20,000 straight away within 14 days.
That's actually a really good point. So we have quite a few extra questions, but maybe we continue with country by country reporting and then we answer the rest of the questions. So Hong, this is another, I will say, underdog topic that sometimes is misunderstood, and it would be great if you could share some of the key aspects of country by country reporting requirements in Malaysia. So specifically, maybe let's start with four key areas. Who does it apply to? What is country by country reporting? When do taxpayers have to lodge, and how do they lodge? So let's start with who does country by country reporting apply to which taxpayers?
All right. Yeah, CPC reporting, I'm sure it only applies to bigger companies. So CPC reporting is introduced alongside the Action 13 plan of the base erosion and profit shifting BEPS initiative by the OECD to tackle the transfer pricing issues in relation to huge multinationals globally, like your Facebook, Amazon alike. In Malaysia, there are two rulings that cover CPC reporting for non-Labuan entities and Labuan entities, right? For non-Labuan entities, it applies to a group of companies with total consolidated group revenue of ringgit Malaysia of 3 billion ringgit, right, and over, and is either an ultimate holding entity incorporated in Malaysia, or if it's a entity incorporated in Malaysia, or a surrogate entity holding entity in Malaysia. Surrogate means an entity appointed by the group to file the CPC report, or a PE in Malaysia, right? Then for Labuan entities, it applies to the ultimate holding entity that's incorporated in Labuan with 3 billion or more in total consolidated group revenue. So these will apply to these entities. And then next, I'm going to talk about what is CPC reporting, right? What is CPC reporting statements in Malaysia? The CPC reporting is in line with the OECD guidelines, whereby it follows a three-tiered approach, where it comprises a CPC report, the master file, and local file, right? The local file in this context is your transfer pricing documentation, right? Then first, I'll show you what the CPC report looks like. Okay. The CPC report is generally prepared by the ultimate holding entity or the surrogate entity. If you look at the tables, it's more of a information gathering sheet about the entire group's financials and operations. So you need to show your revenue, your profit before tax, taxes paid, equities, number of employees, assets for your respective jurisdictions. Then the next slide on table 2, it will show you need to show the lists of the respective constituent entities with their principal activities. So all the entities that's under your consolidated group will need to be listed here. So bear in mind that the CPC report, it's rather scary if you look at it, because you basically need to actually show tax jurisdictions globally, those that shares the CPC report, what other jurisdictions are paying taxes, or the financials, or the PPTs and the principal activities. But it can only be used as for a high level TP risks assessments by the tax authorities, and it can't be used for a detailed TP analysis or any TP adjustments. Right. Okay, next slide. I'm going to talk about the master file. Right, the master file is also prepared by the ultimate holding entity, and is basically a blueprint, sort of a blueprint of the group. You need to show the group's organizational chart, right, on top of your local one. This is actually the whole group's org chart. Description of the group's businesses, the group's intangibles, intercompany financial activities, and then finally the financial and tax positions. Right now in Malaysia, you're not required to lodge the master file to the tax authority. You're only required to provide them upon request to the IRB. So, but this may differ in other jurisdictions. If you have in charge of other jurisdictions, for example, Australia, for example, where you're required to actually lodge the master file, regardless of whether you are the ultimate holding entity or not.
You want to talk about a little bit the filing obligations and the CBCR notification requirements in the following 2 slides?
Yep. So the CPC report needs to be filed by the reporting entity. So the reporting entity here, under the non-Labuan law, it needs to be either filed either by the ultimate holding entity or the surrogate entity that the M&E group has chosen or appointed. But under the Labuan regulations, only the ultimate holding entity has the obligation to file that report.
And then the CBCR notification.
Right. Yep. So for CPCR notification requirements, it's a bit different, right? There's also a very common misconception on CPC reporting notification, where a lot of clients think that only the reporting entity has that obligation to notify IRB who's responsible to lodge the CPC report for the entire group. But bear in mind that non-reporting entity, when I'm talking about non-reporting entity, means that those constituent entities that's under your ultimate holding entity group, they also have that obligation to notify the IRB in writing, to show that all the entities will be included in one notification letter. So all the constituent entity that is under the group will be listed in one letter, then to be submitted to the IRB.
So when do taxpayers need to lodge the CBCR or country by country reporting?
So there's 2 deadlines you need to know. The filing lodgement deadline, which is 12 months after your income year, right? So for example, if you're December year and 31st December 2019, then you have to file before 31st December 2020, right? For the notification, it would be on or before the last day of your reporting financial year. So which means before your financial year end, you have to make sure that you notify the IRB that who's the reporting entity that's obliged to lodge the CPC report and who's the constituent entity under the group.
And this comes very timely with one of the questions of the participants. So how do taxpayers lodge the CBCR in Malaysia?
right? For in Malaysia, unfortunately, it's because it goes in line with OECD, right? So the OECD had to make things difficult for taxpayers, where you are required to first convert your CPC report into an XML format that satisfy the XML schema by the OECD before you lodge. And it makes sense as, I guess, we are trying to unify one universal format to be exchanged between jurisdictions, right? In Malaysia now, once you have it converted to XML, right, that this XML file will need to then be lodged through the IRB tax portal, right?
Excellent.
Which your tax agent should know. So yeah.
I think that answers the last question that we have, which is there a standard format for this CBCR? And I think the answer is yes, and it has to be in this format.
Yeah.
And what are the penalties involved for not lodging CBCR?
All right, penalties again. Failure to submit the CPC report. First, for non-lab one, less hefty, similar to your TP documentation. It's from ringgit Malaysian 20,000 to 100,000, with imprisonment of up to 6 months, right? For directors out there, so you wouldn't want to add on another 6 months to your non-lodgement of your or non-failure furnish of your TP documentation. So bear that in mind. And for directors that have Labuan entities, ultimate holding entities, then your fine is much heftier at not exceeding again Malaysia 1 million or imprisonment of up to 2 years. So bear this in mind and make sure that you put your reminder in your personal calendar to avoid any of the penalties.
So with that, let's open for more questions. We have been having a very active forum today, which is very good. So let me just bring a couple of other questions live so we can help answer. So the first, we already answered this one, which is the standard format for country by country reporting. There is one question that is an interesting one, and is, are related party confined to company level only, or it includes related parties with sole proprietors?
Well, from my view, my opinion is as long as you qualify or meet the definition of related party, you can be a company or sole proprietors. You will be considered to have RPT with that entity.
Yeah. Yep. So if the sole proprietor has dealing with related party, then it makes sense that you may have to be within the scope, right?
Yeah. I'll also give you an example. Very simple. Even directors obtaining loan or providing loans are also captured under in the Malaysian law as well. So bear that in mind. If you have no interest imposed, of course you need to analyze the nature of your advances.
There is another question here, which is, for Form C related party disclosure, should we always follow note to audit financial statements? What if I have some transactions with other related parties that is not disclosed in note or in the note of the audit financial statements? Should I disclose this also?
Yeah, the short answer is yes, because go back to what is the purpose of this form. If you remember, they want a more transparent view of your related party dealings. That is why they come up with this Form C. Basically, they already have your financial statement. This is a more detailed drill down on your financial related party financial dealings. That's why if you have any other dealings that is not in your financial statement and it meets the definition of related party dealings, then you disclose this in Form C.
And I think the other point is that the Form C is a bit more granular, right? So you have to divide by a specific type of transactions that the
transactions by transactions
IRB
by
wants
countries
visibility on, and you have to separate the income and expenses. Whereas a lot of the times when you look at the related party notes, you see lump sums, but you don't necessarily are able to identify the specific income or expense item or the specific type of transaction.
Yeah, sometimes I find it odd as well, where I mean, I've got clients that ask me that, oh, I've got ledgers that have transactions that are actually not in the audit accounts. I'm like, So first, I need a question: what is the auditor doing? How has that missed the auditor's view, right? So, because for us, we do rely on your audit accounts as a preliminary basis to look at what control transaction is in place. But then, to be prudent, then we will need to also analyze what is not captured under your notes, just to be safe.
We have another question here, which I think we kind of answered indirectly, but let me just put it. Are 50% joint venture partners considered related parties in Malaysia? If yes, how do you prepare TP documentation when we have no control over our JV partners and have no information on their pricing? So I think based on the shareholder definition, they are related parties because the shareholder threshold is now 20%. Right?
Well, good news is if you have no information on pricing, which means most likely you'll be arm's length. Of course, you need to be documented down. That'll be extra compliance burden.
But I think it depends on what the transaction is, right? I will struggle to understand if you have a JV and the JV has some transaction with the other partner, I will struggle to understand why the JV, which is the taxpayer that needs to prepare the documentation, wouldn't have pricing information in the first place. I think one of the directors of the JV will have very clear understanding if there is a transaction with one of the JV partners, what is the pricing? So that has been my experience. So I struggle to understand why wouldn't.
And one more thing here, I think 50%, yes, it did pass. It did pass the definition, the new definition. But let's not just focus on the 50%. There's also other criteria to the related party definition. You have to have control. You have to have influence. From there, and then you have to have some sort of directors in the JV. So those part first we need to work it out. And if you really are a related party, and from your comment you say there's no pricing information, that probably you need to find out because once you are a related party, you might need to work out whether or not your transaction is arm's length. But here the indication is you don't have certain information means you are not likely to be influencing the pricing anyway. So it's just a matter of getting the facts right and documenting it down. Yes.
Fair enough. Another question, where is the latest changes to the definition of related party? I think is section 140. That's the latest.
Check I think all the sources will be, as I mentioned earlier, will be in the LHDM website. So they will have all the information in there.
There is another question about joint ventures, but I think we have already discussed this in the sense that JVs, you have to look at the ownership and the influence concept. So I think we have answered this quite a few times. There is another question as payments on behalf of related party considered as financial assistance. Are payments on behalf of related parties considered as financial assistance? Example, payment for compliance fees. But I don't fully understand what the question is.
I guess like just to clarify if I get this question right. So for example, you are your head office or your company, you have a subsidiary somewhere else, either domestic or foreign, that they just start up, they don't have the cash flow to pay their expenses, you're paying it on their behalf. Is that a financial support? So to your question, it really depends on how you treat these transactions. Are you providing it to them as part of their service to you, or are you providing it to them as part of your financial support? You are not expecting to pay back anytime soon or more, or at least within a year, and that would then fall under a definition of financing or loan under the tax ruling. So you have to look at that, right? So a quick and not to say easy, a quick way to look at this is whether or not the financial support you are providing, are you expecting them to settle this within 12 months? If not, it is likely to be considered a financing arrangement.
Okay, fair enough. And I think we are pretty much running out of time, but maybe just one more question here, which is, there is a form for multinational companies that IRB requests more details, such as restructuring activities, R&D, IP information. Is this looks a lot like what we get asked in the master file, isn't it?
Okay, Form M&E, unfortunately, that means you're being targeted by the IRB. Does not mean it will go to a desk audit yet, but which means the purpose of this form is to understand further what else is there apart from your RPT form. But M&E is when it's a indication that IRB needs more information and you're being targeted.
But it seems like some of these questions will be deemed to this restructuring activity and R&D with IP information. Seems to me that what they're trying to understand if there was some type of IP disposal
intangible
or intangible exploitation.
They
or
are
something
basically
like
trying
that.
to see whether or not you have any high risk transaction in place,
Yeah.
or they want more information on those
Yeah.
on those transactions.
Okay, I think with that, we can finalize our webinar for today. Please feel free to visit us in YouTube. We love posting new videos with very key tips and information about transfer pricing. So feel free to follow us. And if you have any questions, please contact us on this email, or you can call us under this number. And you can also follow all of our social media channels, where we will be announcing the next webinars that will be coming in July and June. And with that, thanks to all the attendees who took 1 hour of their time to listen to our presentation today. We hope you find it useful and insightful. And thanks to Hon Chantan and Kevin Tai for your presentation.
Thank you.
Thanks everyone.
Guys.
Excellent.
Thank you. See ya.
See you.